Good afternoon, everyone. It is a great pleasure to be here today. First, let me begin with the fundamental question that has shaped our industry. So, what patterns truly guide financial innovation? If we look closely at history, we discover a recurring theme, a delicate balance between what we call the impossible trinity: the eternal tug of war between yield, efficiency, and risk management. We always strive for all three: higher returns, faster liquidity, and stronger safety. But reality consistently teaches us that we can only optimize two at the expense of the third. Because risk never truly disappears, it only transforms or moves elsewhere. Let's revisit three pivotal moments in financial history, each a story of how we try to challenge this triangle and how the market gently but firmly guided us back to a sustainable balance. First, the pursuit of yield. When Regulation Q limited what banks could offer, money market funds merged with higher yield. But in 2008, the reliance on commercial paper backfired. The lesson learned is that you can't have high yield, high liquidity, and perfect safety. The regulatory response forced a choice: stability through quality asset or higher yield with liquidity restrictions. Second, the quest for efficiency. Traditional mutual funds operated on slow T+1 settlement cycles. Then came ETFs. ETFs changed the game by letting people buy and sell funds in real time, just like stocks. But during the flash crashes in 2010 and 2015, their price disconnected from underlying value. The solution? Trading pauses. Sometimes we must cautiously sacrifice short-term efficiency to preserve long-term market integrity. And third, the engineering of risk control. Structured products like CDOs promised safer risk distribution through models. The 2008 crisis revealed a hard truth: models can't capture all systemic risks. The answer was skin in the game, forcing originators to retain risk, realign interest, and restoring balance. The pattern is clear. We don't defeat the triangle. We live within its rules. Every innovation teaches us a little more about this fundamental dance. Now let's examine how this plays out in today's most exciting innovations. I will take stablecoin and RWA as two examples. Stablecoins present a fascinating case study because they functionally resemble a digital age money market fund. They serve real needs in cross-border payment, but their structural design raises important questions. The core difference is this: unlike traditional funds that distribute yield to holders, most stablecoins retain this value for issuers and operators. We've seen the consequences from reserve transparency issues to depegging events during banking stress. But this isn't a random flow. It's a fundamental trade-off of the impossible trinity in action. The protocol's efficiency and utility are being prioritized, and users' yield is the price. This is why forward-looking regulations like Hong Kong's stablecoin ordinance are so crucial. They are helping us building the foundation for the next generation of finance. By formally recognizing these trade-offs, they are providing the clarity and stability needed for truly sustainable growth. And meanwhile, RWA presents an even more complex puzzle. We are not just dealing with digital native asset anymore, but with the web of complex challenges of connecting blockchain efficiency to real-world value. The challenges we face are both profound and multi-layered. First, a trust problem. The oracle issues persist. How can we be certain that an on-chain token is a true mirror of an off-chain right? Second, a valuation issue. How do we determine the true worth of a tokenized building or a private credit fund during market stress? And third, a legal problem. We operate in a patchwork of global regulations, which creates a landscape of uncertainty. And finally, a privacy problem. As sensitive business data moves on-chain, how do we protect it? We've already seen warning signs from failed projects to illiquid secondary markets. The principle of same activity, same risk, same regulation provides essential guidance, but the implementation requires deep industry expertise. What makes this moment different is that we are not starting from zero. We have decades of innovation to learn from, and we are building on the shoulders of those who navigate previous cycles of discovery and calibration. So, where do we go from here? I believe we are standing at the threshold of RWA's most transformative phase, the shift from simple digitization to true programmability. We are moving beyond asking how do we put this asset on blockchain to how do we reimagine this asset's entire life cycle through smart contracts. The potential is staggering as we shift from static tokens to dynamic, programmable assets. Imagine programmable collateral that self-manages 24/7, auto-adjusting to market moves, no manual margin calls, less systemic risk, or atomic settlement, where asset and payment finalize as one, not just faster, but with zero counterparty risk. Think automated distributions, executing the mathematical precision, no delay, no intermediaries, no just encoded trust. But the real breaking through is embedded compliance. We are baking regulatory requirements like AML, KYC directly into the protocol. It becomes a feature, not a function. This isn't about launching more high-yield product. It's about making RWA the digital raw material of a transparent, accessible system, a programmable economy. Hence, finance become inherently more resilient and inclusive. The trade-offs remain, but we manage them better, finding new balance within the eternal triangle. The path forward requires an honest dialogue between innovators and regulators, learning from both traditional finance wisdom and blockchain's disruptive potential. Just as previous innovations found their sustainable balance, I'm confident that RWA will evolve through the same cycle, but with the advantage of building on everything we've learned. This isn't a future that any single entity can build alone. At HashKey, we are focused on our part, creating the fundamental infrastructure. We look forward to collaborating with all of you to turn this vision into our shared reality. Thank you.
That was amazing. Thank you, Anna.